Good morning and welcome to this session. I'm going to leave my cheat sheet right here, and hopefully I never have to grab it. So today I'm going to go over the causal inference methodologies in intraday equities market making. And I'm going to compare the traditional methods such as group comparisons using t-tests to the more recently developed causal inference methods like synthetic control, synthetic intervention, and causal impact. So here's our brief agenda for the next 20 minutes. We're going to go over a little bit about what is market making and what is a core challenge in market making and the role of a real-time news event. We're going to start with the traditional group comparison methods in doing the t-test comparisons, comparing the group average between the control group and treat group to more focused recent causal inference methods applied to the same space. And the methods we're going to go over is a simple difference in differences, Google's causal impact, CausalLens synthetic intervention, and then we're going to share the results and talk about future work. All right, so what exactly is market making? So market makers are liquidity providers. We match buyers and sellers. So in the quant trading space, we're systematically sending out automated bids and offers continuously during the trading hours. And those bids and offers, they land in our client's order management system, sometimes called OMS. So clients have those quotes and sites, and if they're interested in our quotes, they'll send us a matching order to match with our quotes. So for instance, we're bidding $10 million of IBM, and our clients want to sell $10 million of IBM, and their order will come in towards our system. We go through an automated matching process. If everything matched up, we'll fill their orders automatically. So at that point, the client will have $10 million cash, we'll have $10 million of IBM in our book. And we also have a continuous hedging processing running on the side. So when hedging processing is an optimizer, it sees, okay, I have $10 million of IBM on the book, so I'm going to hedge it fully. So easy peasy, right? Everything works out, so nothing can go wrong, right? So let's take a look. So what is market maker's nightmare? It's right there, the big crocodile straw. So what I just described, the whole process happened within milliseconds. But none of that is market maker's biggest challenge. Market maker's biggest challenge is actually the stock's idiosyncratic risk when the stock is in market maker's book. And those idiosyncratic risks came unannounced. So if you can see this chart, it's an energy stock. It was working pretty nicely, right, with its peers. And it has a nice correlation with the blue line. The blue line and the white line was going well. But as long as when it's in our book, the blue line and the white line goes diverged. It has a huge intraday, we call it idiosyncratic risk or dislocation. This is where the market risk happens to market makers. And if you can see, if we long the stock, which is the white line, and hedge it with a sector ETF, which is a blue line, we're probably losing on both sides. And the jaw can go even wider, can go completely negative correlation. And that's the jaw that's going to eat us market makers' life. So we have to handle that. Oh, sorry, one more thing. So where does the jaw come, right? Like just not so long ago, it was working well. Well, the reasons or the cause can come from a few different places. It may come from liquidity, instantaneous liquidity imbalance, like buy-sell imbalance. In this case, most likely there's a big seller on the stock. Or it can come from temporary technical, oversold or overbought. The stock can be overbought, maybe recently, and it's doing a mean reversion, so it's underperforming the sector. Or it can come from fundamental. And fundamentals are reflected in real-time news events, because news events are actually real-time fundamental updates. And the goal of this session is to quantify how real-time news sentiment events impact intraday stock return. Okay, now we can go to the next slide. So the first methodology I applied is this good old group comparison t-test methodology. And the stocks are grouped into different, by events and also by different buckets. So we have intraday single news, intraday multiple news, overnight single news, and overnight multiple news. Because news affects whether it happens intraday versus whether it happens overnight, they have different impact on a stock. And multiple news also have different impact from single news. We have 4 different buckets, and on the row-wise, we group them by different news events for the given day. And both parametric and non-parametric t-tests was applied. And the universe coverage was about 1,200 stocks from both US and Canada, and the time range was between 2017 and 2023, earlier this year, 2023. And from the high level look of the results, they actually make sense. The results match with intuition. The bad events, like the events we expect to have a negative impact, such as downgrades, inside sellers, do have strong negative t-stats. And the good events, which is upgrades and inside buyers, they do show up as strong positive significant t-stats. So it makes sense, right? We feel good about our hypothesis that news have impact on stock returns, and there's something in it matches with our intuition. But there are 2 large hurdles of this t-test approach. So the first one is t-tests cannot provide unbiased intraday trading strategies, as they cannot capture or condition confounders in a very robust way. So what do we mean by confounders here? So if we go back to this, the test here, we do use access returns. So access returns is we conditioned upon the sector returns from the stock return. So we do condition something. We took out the sector's return from the stock return. But there are far more than just the sector returns happening in the stock market. It could be a risk-on, risk-off regime difference. It could have a sector rotational. It has a style rotation happening when all those news are happening. So a t-test there's no easy way to condition those confounders as covariates. That's one biggest problem. And therefore, we're not 100% certain that those impacts are indeed only coming from news. It could be something else. But the second large hurdle is it's very difficult to mimic time series framework in t-tests. It just doesn't provide a natural way to plug in time series in the framework. And time series is absolutely critical and essential for stock trading and stock management, risk management. So what do we need here? We need to model time series with a causality base. And we need to provide unbiased point-wise prediction. And we also need to have a very robust, clear way to separate the actual move versus counterfactual move pre-post intervention. We want to know what the stock was happening pre-event and what stock happens after event, and how do we assess that impact after the event. And for t-tests, it only met really half of the first requirement. And the causal inference methods, as we're going to see, they match the other 3, all 4 requirements. So here, enter the causal inference method. And how do we construct a causal inference build up the model? There are a couple of steps. First, we choose an industrial group to focus on. One very important construction in the causal inference method is your treat group and your control group has to have a lot of similarities. So the first and the foundational cut is to choose all the stocks in the same sub-industry. So first we choose an industry group to focus on, and in my study case, I choose the Canadian gold mining sector. It has about 60 stocks. And the time frame I used for this study is from January 2022 to June of this year. And then we spend a lot of time defining the treatment group and control stocks. So the treatment group is simple to start with. It's the stocks that actually had events on that day. And the event we focus on here is the target price downgrade. A target price downgrade is analysts issued a target price downgrade on a stock intraday. And so the treat group is the stocks that have the target price downgrade on that day, intraday, during trading hours. And the control group is all the rest of the stocks in the same Canadian gold mining that has no news on that day. Not just they don't have target downgrade, but they have no other news either. But in addition to that, because we want to find those, we want to group find the similarities as much as possible, we actually filtered on some additional variables, such as overnight return. Because overnight return has an impact on how the stock is going to behave intraday the next day. Overnight is from previous close to today's open. So we find the same, we only look for the same pattern with overnight group, overnight return in the control group with the treat group. So if the treat group has a positive overnight return, the control groups, all the stocks in the control groups all have positive overnight returns. And the other one we filter on is we have to ensure some minimum correlation for the returns pre-event between the control stocks and the treat stocks. With all those in place, we build a counterfactual time series, and then we estimate the impact. I'm going to go quickly to the appendix to show you what data frame we put into the model. Just let me go quickly here. There. So this is a test case we're going to go through for the causal inference methods. A stock called symbol AR had a price downgrade on March 7th at 11:43. And the control group it looks at is all the other stocks in the same sector that has no news and with the same overnight return pattern, as well as it has some correlation with the stock AR. And on the row-wise, it is by minute cumulative access returns. So every minute is its cumulative access returns for the stock from open to close. So there are 390 minutes in the trading day, and we actually have 391 data points. The first data point being the overnight return. All right, let's go back to the ones we're prepared. Oops. Oh, yeah, here we go. Validating results. Sorry, almost there. Yeah, right here. OK, so using that test case, this is a generic view of what the output looks like for causal inference methodologies. And you can see the vertical line is where the price downgrade happened around 11:43. And pre 11:43, that's the model fitting. It finds the weights from the control group to fit the actual returns of the treat group pre-event. And post-event, the dark line is the projection, or we call the counterfactual time series. The estimates about how the treat stock AR would have behaved had the downgrade did not happen on that day. And the gray line is its actual returns. And the difference is the causal impact, or the impact we want to look at. The gray area is a confidence interval. Next. So we tried 3 different causal inference methods. The first one is the great-grandfather of causal inference, a simple difference in differences. And the biggest upside of the difference in differences is its simplicity. We can manually quantify what the counterfactual data point is. But also the downside of differences is exactly the other side of the coin. It is too simple, and it may not be expressive enough to capture all the underlying behavior of the time series and its causality. And then we tried Bayesian-based Causal Impact. So the Google implementation was first pushed out by Kai Brodenson and the Google's team, and they have an implementation in R, use a Gibbs sampling. The time series modeling is a Bayesian time structure to catch the local trends, and if you have seasonalities, it can plug in that as well to catch more intricacy of the time series. And we can pass in non-stationary time series into the model without pre-processing the non-stationarity. So Google have the version in R, and then the version I tried here is from Python, which is implemented separately by Will Fuchs. And the model was implemented on top of a TensorFlow probability. And to fitting methodology was a variational inference and a Hamilton Monte Carlo. And then I also tried synthetic intervention. And this is implemented by our very own CausalLens team here. And they use principal component regression to capture the model fitting from the control group to the treat group. And they also have a way to handle non-stationary time series. Yeah. All right. So high-level summary before we go into details is we found causal methods can infer significant negative impact on the price downgrade, at least for this test case we're seeing. And both causal impact and synthetic control methods give very similar results. However, cross-validation gave us mixed results, which we are going to talk about future work. So here's a result from a difference in differences. As you can see, we can capture the difference very easily, which is the difference between stock AR and its control basket before the intervention, is 0.1515 here, and then just shift this constant difference to the difference in the post-stock downgrade, which is 0.5386 here. And then we add them up. That became our counterfactual data, 0.6901. So it's very easy. You can even manually calculate. Although we can also go through simple ordinary least square to capture the coefficient on the interactive term. You get the same data. But it's very easy to understand, OK, you have a constant shift pre and post. All right. So Google Causal Impact, as you can see here, very identical charts as we saw before, capture the fitting the model pre-intervention between the control basket and the treat stock, and then projecting the counterfactual move, which is a dark line you see. Which is the red dotted line you see over on top. So based on the counterfactual time series, the stock AR, if it had not, the price downgrade didn't happen to it, it would have moved drifting along the red dotted line. But with the price downgrade, the actual return is actually the black line. So you can see it implies a negative impact between for the event, given the event, the negative impact between the red and the dark one. So the cumulative negative impact for the stock, since it received the event, is about 1.5 on the second chart. The third chart we can ignore because since we're using the cumulative rolling axis return to begin with. And then we can also get the different weights from the Google Impact model. By the way, the difference in difference model, it has equal weights. So that's another limitation. OK, so here we have the CausalLens synthetic control, synthetic intervention results. A very similar graph you saw before. We also have point-wise cumulative return here. And you can see at the bottom of the page, the cumulative impact is also around 1.5. So we have similar results here. All right, so we've gone through 3 models. The model fits the domain space. It fits. We can get some actionable items here, and so it works, right? We should just move into production. Well, not so fast. We have to do validation tests across the universe, and I ran the same model across the universe for the time series, for the time period we tested, and they actually, many of the test cases, many of the cases, they rendered very reasonable results, just like the results we saw. But we need to have like a statistical confidence that the model is actually going to perform well. So there are a couple of different validation tests that was recommended. In the original paper by Abadi in synthetic control, it mentioned permutation tests and robustness tests. So permutation test is like this. It's actually a placebo test on the control group. So we would iterate through the members in the control group and going through the same event. Well, the control group never had a price downgrade on that day. So that's why it's a placebo to the control group. But then we want to see how the model reacts for a placebo event. And the output for that test is something called post-pre-RMSE. So root mean square error. So we want to look at the root mean square error difference between post-placebo intervention to pre-placebo intervention. We assume they're going to stay alike. So if they stay identical, then the ratio will be fairly low, except for the stocks that actually went through the treatment. So CausalLens model actually have such validation tests built into the model. It's on the top right corner here. So you can see that AR, which is our treat group, is the second highest post-pre-RMSE ratio. Another test is something called robustness check. Robustness check is to test, okay, what if I change my control group a little bit? Right, I'm taking one members out of the control group, one at a time, and just see if I still get the same counterfactual time series if I do that. And again, CausalLens has a built-in robustness test right here on the lower right corner. The dotted black line is the one that we have every member in the control group. The gray lines are the ones we took one out through iterations. You can see the correlation is actually pretty high, except for two of them. So these two tests gave us a comfort. We think the baseline looks okay, but we want a more strict test. We want a true cross-validation test. And the cross-validation test we're doing here is taking all the time data point pre-price downgrade, and then we randomly creating placebo interventions for that time period. Because for that time period, the event didn't happen yet. And if we take those placebo tests, we were expecting the R-square in the test data will remain pretty high relative to the pre-intervention R-square. And unfortunately, that's not what we found. We found mixed results. Sometimes the R-square looks good, but there's enough cases we need to dig into. The R-square doesn't look good. We expect them to look good because the event hasn't happened yet. And that's where we need future work. So hold that thought in your head for a bit. I will come back to that. But first, let me summarize the beginning purpose of this study, which is from traditional method to causal method. Again, hopefully it's a little bit clear to everyone now. The t-test is very good at defining the event impact on the very average statistics, but it lacks the confounding conditional mechanism, and also it doesn't have a time series framework built into it. The causal method has all of that. Have all of that capabilities, and we can turn into something actionable for trading. However, at this stage, we still need more research into looking at why the cross-validation doesn't really work out as we hope it did. So some of the immediate action I can think of is, first, we can re-examine the control group. So even though the control group is from the same industrial sector, there might be other better ways to find similarity control groups. Because the industrial factor is defined by gigs, and which is defined by revenue streams to companies. So the companies sharing the most common revenue streams are in the same sector. But there might be other features that the companies may be the same. such as in the gig study, folks found, okay, the Amazon is a consumer stock or is a technology stock, or is it somewhere in between? So just strictly by defining by gig sector may not be the best way to define similarity group. The second one is we may want to look into, did the model overfit? I have an intuition that Google's impact model, because of the mechanism of variational inference and Monte Carlo, Hamilton Monte Carlo, it might overfit because just the way how those mechanism works. However, in a principal component regression model, the goal is actually not to overfit the model. So we have to look into what else is going on there. By the way, I missed one point in the synthetic intervention model built by CausalLens team. They also testing two very significant assumptions. One is low rank, so the model doesn't overfit. The other one is causal transportability between pre-event to post-event. Okay, so as a bank, we're very practical, right? We look at bottom line all the time. So how should we understand this process? We do a lot of, we invest time in research, and we always have to show how it trickles down to bottom line. So I think we want to operate in the mindset of biotech companies or pharmaceutical companies that you always keep your pipeline running when you have something in production. So we want to keep pushing incremental actionables into production while keep researching in the pipeline, in the cutting edge front line in the research area, because research will show us something that we don't see in observational data, and it will lead us to opportunities and prevent us from the pitfalls. Thank you very much. I'm open for questions.
Great, thank you very much for that talk. I think we have time for a handful of questions here. So does anybody have any questions for Judith? We have one right here in the front.
Can you speak more about the similarity process? Is that out of the box that you were using for that? Was there like some slope matching process for determining whether they were similar for the control?
Sure, absolutely. So the first cut is all those stocks have to come from the same industry group. So they are all gold mining stocks. And the second cut is I look at because it's intraday, so the time spent is short enough to hold the assumption that those stocks will behave the same if nothing else happened. And so, but the second filter is overnight return, because overnight return have an impact on intraday behavior. And if a big positive overnight return, because of the sources how overnight return comes about. Overnight trading usually have very thin liquidity, so small trade will move the price in a big way. And those big returns, overnight returns, usually get reverted the next day when the liquidity is there. So we find the same overnight return patterns in the control group. So if the treat stock has positive overnight return, all the stocks in the control group, they all have positive overnight return. And also I impose, I made an optional parameter, but I do impose the minimum correlation between the treat stock and the control group before the event happened. And my threshold correlation cutoff is 40% at the moment. Thanks.
Great. Well, it seems like that's all for the questions right now. Oh, wait, we do have one last question here from over here on the left-hand side.
So for your future research, you talked about improving the method for finding the control group, or defining the control group better, right? What about the impact, the causal impact intraday, and what is actually creating the deviation from the control group? Is that important to you guys? And then how would you go about trying to calibrate that better? Because that's a problem with both the causal methods. They aren't quite getting you there, right? So.
Yeah, so you're asking how do we use it, right? Why do we care, right? So the way we can use it is assessing the impact of those events, because not all the events have the same impact. And based on those assessments, so we can modulate our couple different places. One is our bid offer quotes. We can either make adjustments there to make it less risky for our positions, and also we can manage in the existing positions on the book. If we are long something and we just had a price downgrade, and we can figure out, okay, shall we actually take out the risk more quickly than usual, or how long it's going to last? How much the impact, it really matters for the remaining of the day. Because our study horizon is only from when the event happened to the end of the day. So we're assessing how much impact we're going to have for the remaining of the day. If it's going to have just for a huge negative impact for a few hours, and the next few hours it actually revert, then we're not that worried. We're not that nervous, right? We can let it flow. But if it goes all the way down towards the end of the day, then we may have to do something. We may want to do something there. Yeah, thanks.
Great, thank you. Let's thank Judith again for that
Okay.
very great presentation.
Thanks, everyone. Okay.
Thank you very much.
Thank you.